What's up, guys? In today's video, I'm going to be showing you how to protect your stock portfolio for free. Now, there's a lot of crazy movement going on in the market right now. We're seeing a huge divergence between value stocks and growth stocks. We have the Dow basically at all-time highs. We have a lot of growth stocks down significantly. DraftKings, Zoom, Palantir, NIO, Enphase, Tesla, and even if you just look at the ARK ETF, ARKK, it's down significantly from all-time highs. So basically in this video, I'm going to be showing you some creative ways to hedge your stock positions for free. Now, everyone knows that you can just buy put options and protect your portfolio that way, but that can sometimes be pretty expensive. Put options can definitely be expensive, especially when the market has pulled back like it's done. So what I'm going to be showing you is how to get those put options basically for free. So before we get into the strategy, I would greatly appreciate it if you could subscribe to the channel. I post brand new videos every single day, but let's get right into today's video. So for today's example, we're going to be looking at NIO. This has been an amazing growth stock over the past year. It went from $3 all the way up to 67, all the way back down to 33. Let's say you're someone who, let's say you bought NIO at $20 each back in September. It doesn't really matter that you bought it at this price, but let's just say for the example, let's say you bought 100 shares of NIO at $20 each, and you saw it go from $20 all the way up to 67, then all the way back down to 33. And you're saying, well, if it went from 67 down to 33 in a couple months, maybe it'll go down to 30 or 25 or 20 or $10. Who knows? And let's say you want to hedge your portfolio. Of course, you can buy that 30 strike put option, but it'll cost you around $284. And I'm talking about the 30 strike put option that expires on August 20th of 2021. And like I said, let's say you have 100 shares of NIO at $20 each. What you can do is a creative way to finance this put option is you can go out to, let's say you go to the 38 strike call. You can sell this 38 strike call option for around $284. And at the same time, you can buy the 30 strike put option for around $284. So if you sell a covered call and then you buy a put, essentially what you do is you eliminate downside risk while also limiting upside potential, but it's completely free. So it's literally a free hedge. What you can do in the market right now is if you have at least 100 shares of any stock that has options available to trade, you can write call option or write covered calls and then use that money to buy puts. And what this essentially is doing is a completely free hedge. So if we look at NIO's example, let's say you have 100 shares at $20, 100 shares at $20 each. If you bought this 30 strike put option, no matter how low NIO goes, you will have the right to sell your 100 shares at $30 each. And that will result in a $1,000 profit because you bought 100 shares at 20. And if you sold 100 shares at 30, that's a $1,000 profit. Now, to get this put option for free, you have to find a covered call that you can write that is that covers at least the price of that put option. In this example, it is the 38 strike call. Now, the only downside of doing this is, let's say NIO skyrockets, right? Let's say it skyrockets all the way up to $45. You're gonna have to sell your shares at 38. But let's say NIO doesn't skyrocket. If it tanks, then you're kind of screwed. But let's say NIO goes up to $37, then you're still good. You keep your shares. So basically, let's take a look at the risk profile. What this strategy is technically called is an options collar. Basically, you sell a covered call and you use that money to buy a put, and it can really hedge your portfolio. This strategy is not going to make you rich, but it's essentially a completely free hedge. In these market conditions, it's not a bad strategy. So if we look at the risk profile for this trade, let's say we go over to the risk profile right now. And if we look at it right here, I'm just going to zoom out a little bit right here. In the worst case scenario for this specific trade, you are going to make $1,000 because you have 100 shares at $20 each. In the worst case scenario, you have to sell your shares at $30 each. in the best case scenario, NIO is above $38. You will make $1,800 because you bought your shares at 20 and then you have to sell them at 38, right? So that's a $1,800 profit. Let's say NIO is anywhere in between. Let's say NIO closes at $34 on your expiration date, which is August 20th of 2021. You still get to keep your shares, and then the put option expires worthless, and so does the call option. So basically, you just had a free hedge. So you lose nothing by doing this. You just get to keep your shares. But since the share price is at $34 and you bought at 20, you have an unrealized gain of $1,400. Now, there are many different ways to go about doing this. You can, like, there's literally so many different ways you can customize this spread. And this is why I love options, because there are so many different creative and strategic things you can do with them. A lot of people I know, when they look at an options chain, they're just trying to find like maybe like the cheapest call option that they can buy and day trade or hold for 2 or 3 days. But the options chain gives you so many opportunities to hedge your portfolio and put yourself in good positions. So if we go back to the options chain, I just want to give you guys a couple different ideas on how you can potentially hedge or kind of customize this type of spread. So maybe instead of selling the 38 strike call for $284 and then buying the 30 strike put for $284, what if you maybe sold the 42 strike call for $200 each, and then you bought the 30 strike put for $284 each, right? So basically what that will do is, let me pull this up. So basically what this will do is it'll cost you around $84 out of pocket. You're getting paid $200 upfront in cash for writing this 42 strike call, while it will cost you $284 out of your own money to buy those 30 strike puts. So this will cost you $84, but also it will give you more potential for reward. So if we go over and we change this from the 38 strike call to the 42 strike call, let me change it right here, 42 strike call, we can see that the risk profile changes a little bit. Let me unlock this. The risk profile changes a little bit. But at the end of the day, instead of having like in the worst case scenario, instead of making $1,000, you would make 904. And then in the best case scenario, instead of making 1,800, you would make 2,100. So the main point of this is just to show you that there are so many different ways to customize this. And I hope this video helped you and just showed you that there are so many different things you can do with the options chain. If it did, I would greatly appreciate it if you could hit that like button, and please consider subscribing. I post brand new videos every single day. And if you have any questions, let me know in the comments down below. But other than that, thanks for watching.